In this video, we will explore fundamental market theory that explains why it actually moves, and in the end, we'll learn how to apply all of this in real trading. First, we need to understand what supply and demand are, so let's give these terms the shortest but clearest definition possible. Demand reflects the volume of goods or services that buyers want and are able to purchase at a certain price. Supply reflects the volume of goods or services that sellers are willing to provide to the market at a certain price. The key words here are volume and price. Let's imagine the following situation. There is a seller in the market who wants to sell 10 shares at $10 each. In this case, the total supply volume is $100. At the same time, there is a buyer who is willing to buy exactly 10 shares at the same price. Thus, supply and demand are in equilibrium, and a $100 transaction takes place in the market. The shares go to the buyer, and the seller receives their money, while the price remains stable because the forces affecting it are balanced. But what happens if the seller still wants to sell 10 shares at $10, but the buyer is only willing to buy 5? In this case, the supply volume will exceed the demand volume. The market will be in a state of imbalance and the price will start to decline. Why? Because there is currently no one to buy the remaining 5 shares at $10. For the transaction to take place, the seller must lower the price until a new buyer is found who is willing to purchase the remaining shares, for example, at $9. Thus, the market price is not just a fixed number, but rather a dynamic indicator that is formed in real time through the interaction of supply and demand. When there are more buyers than sellers, the price rises as those wanting to buy are willing to pay more, competing for a limited number of shares. When there are more sellers than buyers, the price falls as sellers are forced to make concessions to find buyers. But there's another side to the coin. Let's say the stock price starts to rise. Initially, they were worth $10, but now due to high demand, the price rises to $12. What happens at this moment? First, some of the buyers who are ready to buy shares at $10 now begin to wonder, is it worth paying more? They start to hesitate or abandon the purchase altogether because the price seems inflated. This reduces overall demand. Second, among those who already own shares, there are those who want to lock in profits. If someone bought shares at $10 and can now sell them at $12, why not take advantage of the opportunity? As a result, the market supply increases. More people are ready to sell than buy. This leads to natural self-regulation. Price increases inherently generate greater supply and reduced demand, which ultimately leads to stabilization or even price decrease. Now let's examine the opposite situation. If the price starts falling, say from $10 to $8, most sellers instead try not to sell, waiting for better prices. However, among buyers, there are more willing to buy, since the asset now seems cheap. As a result, demand increases, supply decreases, and the market balances again. This mechanism underlies all market movements. The higher the price, the fewer buyers and more sellers; the lower the price, the more buyers and fewer sellers. This is why the market moves in cascades, constantly transitioning between states of balance and imbalance. If we draw a conclusion from what I've just explained, we can arrive at one key insight. Regardless of what volume of an asset is currently available for sale or purchase, whether it's $1 million or just 1,000, if at that same moment there are an equal number of willing buyers and sellers, the market will remain in a state of balance, and there will simply be an efficient exchange at the current price. Similarly, if at that same moment there isn't an equal number of parties willing to buy or sell the same amount, the market will be in a state of imbalance and will move up or down until the deficit of buyers or sellers is eliminated. Conclusion: fundamentally, the market moves not because someone strongly dominates, but because there is a deficit on one side. Remember this once and for all, but we'll return to this concept later. Now a question might arise. Do buyers and sellers really make trades solely because the price has become attractive to them? Is the only reason for selling a high price and for buying a low price? Actually, no. There's such a thing as triggers, events that stimulate market participants to take certain actions in the market. Examples of triggers: testing of price action elements, which I've repeatedly discussed on the channel. Price approaching historical highs and lows. If the price previously reversed from a certain level, market participants are highly likely to pay attention to it again. Psychological levels, round numbers, levels like $100, $500, $1,000 per asset. People tend to place limit orders at such values, making them natural points of supply and demand concentration. Among the triggers are also macroeconomic factors, which often act as catalysts for sharp movements. For example, central bank decisions on interest rates. If the rate increases, this can negatively affect the market, as loans become more expensive and the economy slows down. If the rate decreases, conversely, the market receives support. Inflation reports. High inflation rates can intensify investor concerns, leading to a decrease in asset values. Labor market, NFP, unemployment. Strong employment data can increase confidence in the economy, supporting the market. Weak indicators, conversely, can trigger a decline. Also, political events. Elections in major economies, military conflicts or sanctions, crises, pandemics. Such events often lead to capital flight and can radically change investment preferences. To sum up, we can say that triggers affect supply and demand, and when they are equal to each other, the market is in a state of equilibrium, and the price doesn't move anywhere. If there's a deficit of buyers, the price will fall until it finds them. If there's a deficit of sellers, the price will rise until it finds them. Therefore, as traders, we don't always need to identify the strength of any market side to open our positions. On the contrary, we need to identify weaknesses for a high probability positive outcome. This table, along with the schematic representation of the law of supply and demand, describes all these options briefly.
Take a screenshot, it will help you in your trading journey.
Let's look at real charts. This is the US dollar versus Japanese yen pair on the daily time frame. Looking at the overall perspective, the price is moving in a downward order flow, which indicates buyer weakness throughout this movement. From the very beginning, the price forms a fair value gap and tests it, as well as a bearish dealing range. Then we see a liquidity raid from both sides, which ultimately creates two order block zones. These are then tested, and the price again receives, as we say, selling volume and so on. But since I want to show you an example of an interesting position, let's focus our attention on the last section of the chart. Two elements immediately catch the eye: a wide fair value gap and an order block. All this in the context of a bearish dealing range. The price makes quite an impulsive correction, and it turns out that according to all timings, the daily candle closes above the upper border of the FVG, thereby invalidating it. But since there is an order block at the very beginning of the movement, this leads to a reversal and potential formation of another FVG. Why potential? Because the daily candle hasn't closed here yet. This is the overall context to help you understand one simple thing. We see a huge number of signals indicating that the price is moving down, and we should work accordingly. Now for the most interesting part. On the 4-hour time frame, there are equal lows as a point from which a reaction and subsequent reversal may occur due to buyer volume. But when we switch to the hourly time frame, we can see that after the raid and pullback, to the nearest FVG there was another liquidity raid of the newly formed fractal low. This indicates that buyers at these levels are weak and cannot provide enough volume immediately in the context of the raid for us to see a full reversal. Therefore, our primary task here is to wait for the price to reach the nearest price zone on the 4-hour time frame, from where we will make further decisions. This turns out to be a bearish fair value gap. On the hourly time frame, this correction occurs without any inefficiencies, which again indicates buyer weakness. A 1-hour fractal high liquidity raid takes place, and when we switch to the 15-minute time frame, we can see an FVG as volume confirmation. Now we can very confidently place our sell order from this zone, with the stop loss placed beyond the local extreme. As for take profit, there are two options. The first and safest is the local 4-hour fractal low, which gives us a risk-to-reward ratio of 2.86. The second option is to look at more global targets. For example, on the daily time frame, this could be the rejection block, up to the upper border of which we can get a risk-to-reward ratio of 3.4, which is already better. Actually, we see that the price very quickly reaches the targets we set, and this is all thanks to the fact that we were able to identify the overall weakness of buyers, and even local weakness in the context of the raid itself, which gave such a good result. Additionally, I'd like to note that our idea synchronized with the 4-hour dealing range, and the raid occurred at the London session opening, which further increased the probability of a positive outcome. If you like this video, please leave a like, write any comment and share it with friends so YouTube notices this video. Additionally, you can check out my other social media. All links will be in the description. Thanks for watching.